What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF, and we're also going to cover some other notable names on the market, such as Apple, Nvidia, Tesla, which reports earnings this week, and we'll go over those earnings projections and price targets, AMD, Meta, and Amazon. So before we jump into these charts and price targets, let's talk about some key events that happened last week and some things that are happening this week that may potentially help markets recover back up or force them to pull back even lower. First and foremost, the biggest thing that happened last week was actually an unexpected event that happened because of a CrowdStrike failure, and it caused an entire global IT meltdown, impacting many industries and thousands of companies. Now, with that being said, it wasn't exactly the CrowdStrike failure that single-handedly drove markets lower. It was the combination of uncertainty around the Biden administration, of course, around the Democrats, and the assassination attempt on Trump. As there's turbulence in the US politics, the market will ultimately pay the price, and we're going to see a lot of back and forth in between now and the election as the sentiment goes between Trump and Biden, or whoever the Democrats decide to put up as the next leader. Now, apart from that, last week was kind of a quiet week, but we did have earnings from Netflix and TSM. The companies reacted very subtly to their earnings. Taiwan Semiconductor stayed relatively flat despite having beat expectations and growing their profits year over year by 30%. You can see that the company did not react very well to such a strong positive report. And the reason why that could be is because it was already priced in. Many companies, you have to remember, are already trading near their all-time highs, or at least near their 52-week highs. So it's not enough that they beat earnings. They are also needing to beat earnings significantly and give strong guidance in order for buyers to be satisfied enough to continue buying them up. This was the same case with Netflix, which also posted phenomenal earnings. However, you can see that the company ended lower and closed right above its 100-day moving average. Now, this week's attention shifts a little bit, but we are still focused on earnings. Earnings from Tesla, IBM, big companies such as Coca-Cola, and of course Google are all expected this week. We're going to go over Tesla's earnings in specific in just a little bit. But outside of that, we also have the PCE and the GDP reports. Now, the PCE report, which is the Personal Consumption Expenditures Price Index, this report is the Fed's preferred inflation gauge. So the Federal Reserve watches this closely, and they're looking for it to hit the 2% mark before they're comfortable in lowering interest rates. Remember that this report is going to influence what the Feds do on next week. So not this week, but next week, we do have the FOMC meeting, and they're going to be deciding interest rates to end July. So this report this week, the PCE report, depending on what the outcome is going to influence what they say on that FOMC. So when you're looking at the market this week, don't only focus on this week's picture. Remember that the week following this week, we're also expecting the FOMC, which will ultimately be impacted by this week's report. So keep an eye on that and keep your mind on the following week. The GDP report is also expected this week. You can see that the US GDP rate has been falling quarter over quarter. Last quarter ended at 1.4%. We are expected to see a little bit of improvement on this GDP to 1.9%. However, that's still lower than the previous 3 quarters, and that's an alarming sign because the further we get closer to zero, the further likely that we can dip into a recession. Remember, a recession is 2 back-to-back quarters of negative growth, and although we're not there yet, we are headed in that direction. And that's why there is so much pressure on the Federal Reserve right now to lower interest rates, because our GDP is starting to sink. Yes, inflation is easing, but it's also impacting our GDP because of lowered ability to spending, and that ultimately can drive us into a recession. So the Federal Reserve is walking a thin line right now. They're going to need to make a move very quickly in order to avoid our GDP falling into the negative territory. And so that's as far as all the economic front goes. Let's go ahead and dive into our charts and talk about those projections. So for SPY in specific, we're going to look at the hourly time frame, but before we do so, we're going to zoom out and look at the daily time frame. Last week, we closed below a very significant support line, and that was the 20-day moving average. This is a point that we haven't broken since the end of May, and you can see that even when we broke it at that time, we quickly recovered and continued surging higher. The 10 and 20-day moving averages have been acting as a major support for our rally ever since the rally started back in November of last year. You can see that we held them as a support for quite some time, for months at a time. When we dipped below them, we came down to the 100-day moving average and bounced back up. And now that we're back below them, we are at risk of falling towards the 50 and the 100-day moving averages once again. Now, if you don't have these on your chart, you need to have the 10, 20, 50, 100, and 200-day moving averages. Institutional traders and Wall Street uses these lines to gauge whether or not the stock or the index is currently in a bullish or a bearish trend. And the longer the moving average is, which means that if you go from the 20 to the 50, the more significance and weight that it holds. And so as we come down, if we come down to that 50-day moving average and we fail to hold like we did here, we are at risk of falling lower. So the first thing and the last thing you should do every single day this week is on the daily time frame, open that up at the beginning and at the end of every day and figure out where that daily candle opened and closed in relation to these moving averages. As long as we're trading below the 10 and the 20-day moving averages, then we are at risk of falling lower. Now, if you are looking at the shorter term time frame, here are some levels to focus on. First and foremost, your support now is 547.70. This is the same support that we had on our chart last week. You can see that we came down and closed right above that level. If we move below that level, the next downside target is going to be around 542, and that's an obvious support because you can see there was a lot of buildup around that level before we rallied into all-time high. So buyers are going to need to defend it, and they're not going to be too happy if it breaks below it. If we do break below 542, then we are at risk of nearly free falling towards 533 to 535. Now on the bullish side, there's not really a lot of resistance in our way before 557.20, but if we did need to make some kind of resistance point, then we would put it right around 554, but we're not really counting any resistance till 557.20. Remember, the general trend is still bullish, so it's not unusual or unlikely that we see a bounce. Many people have been waiting for markets to pull back in order for them to buy the dip, and so if we do see a bounce early on in the week, that's completely healthy and normal, but don't be too quick to trust this bounce because it may take some time for us to consolidate and rebuild that confidence before we can break out into another all-time high. And also remember, there are still dozens of key earnings reports that are expected in the coming weeks, so it's very unlikely that we can hold any single-sided rally because we need to see the outcome of those results before investors start taking on positions comfortably. Now, the next stock on our watches is going to be Apple, which reached another new all-time high. However, you can see that by end of the week, the stock pulled back and closed just above its 20-day moving average. Again, like SPY, Apple is using the 10 and 20-day moving averages significantly as support points. So the first thing and the last thing you should do this week is figure out where did Apple open and close in relation to these moving averages. Now on Friday, you can see that Apple closed at the lows of this big red candle, which means that there's a lot of bearish pressure and we may see bears try to take the trend to start off the week. If they do, they're going to need to break below 221.50, which would also put Apple below its 20-day moving average. And the next support below that is going to be 217.50. We don't see much support below that point, you guys. So if it does break that level, it could be a critical and a pivotal break. We're actually going to put pivotal right here for you guys. And if it breaks below that level, then it can free fall towards 205.50, which will ultimately put it back at its 50-day moving average, which you can see that when it broke back above, it rallied for months to follow. So if it breaks back below, it could spell some trouble. Remember, this is a pretty aggressive downside price target, so it's unlikely to hit it this week. Make sure you guys are checking back in next week so we can update you on these levels. The next stock on our watches is going to be Nvidia, which you can obviously see saw a lot of bearish pressure, and it ended the week right at its 50-day moving average. Again, a point in which you should be checking at the beginning and at the end of every day. Now, bearish pressure did ease a little bit by end of week. You can see that volume fell, but there's still a lot of pressure and we're still expecting Nvidia to come down lower in the coming weeks. Now remember, everybody has been waiting for Nvidia to pull back, so just like SPY, it may see a small bounce to start the week. Be careful not to trust that bounce too quickly because it's likely just a dead cat bounce before the stock sees lower lows. Here are some levels to focus on for Nvidia. So the next support is the same support that we had on our chart last week, which was 115. If it breaks below that level, the next downside target we have is 107, and below 107, Nvidia is going back to double-digit points. So yes, it's not what everybody wants to hear, but it may be necessary for Nvidia investors to pull back before they get comfortable again in buying the dip and pushing it back towards all-time highs. The next stock on our watch list is going to be Tesla. Now, Tesla reports earnings this week, and let's see what markets are expecting from this one. You can see that for the July 26th, implied volatility is around 102% for the stock. This translates to about a $23 move. So following the earnings report and following this week, investors either expect Tesla to jump back towards 260 plus or to fall back towards 220 and below. So if these are what investors are expecting, then let's talk about the numbers that they're expecting from the stock. Fundamentally, the company is expected to improve. You can see that their earnings per share is expected to jump from last quarter's 35 cents to about 46 cents per share. That's a pretty significant improvement. Now, that's important for Tesla, not only because, of course, investors want to see a profitable company, but it's also important because when we look at Tesla's price to earnings ratio, we can see that the stock is currently trading at a price to earnings ratio of 63. Now, a healthy price to earnings ratio is going to be anywhere between 15 and 25. The cheaper, the better. So if you find a company that's trading at a price to earnings ratio of 15 and below, that might be an attractive purchase, especially if their profits are expected to grow. There are two ways to adjust the price to earnings ratio to a more reasonable or to a more attractive state. One, by the stock coming down lower, so the price and the valuation comes down, causing the price to earnings ratio to go lower, or the company improves its profitability and profit margins, which Tesla is expected to do so in the coming quarters. So as Tesla improves those profitability margins, then its price to earnings ratio will come down and its stock will look even more attractive. And so it's very important that Tesla meets profitability. Revenue is expected to grow. That's a given the fact that they already beat on deliveries, but profitability is going to be the biggest question because investors want to know if this company is overvalued, undervalued, and how they're reacting to the recent changes that they did on their vehicles in terms of pricing. So here are the levels to focus on for Tesla. We already explained that there's going to be a $20 move on earnings, or at least a projected move of $20. It may stay flat depending on what they report, but the expected move is about $20 higher or $20 lower following the earnings report. The next stock on our watch list is going to be AMD, which spelled trouble last week for many buyers. You can see that the stock attempted to hold above 180, but by end of week, the stock sold off and it actually closed below its 100-day moving average. This is the first time the stock is trading below this level since November of last year, and that was when the big rally started. AMD is one of those companies that's trading at a very inflated price to earnings ratio. We already explained this in previous videos, but just to give you an idea, price to earnings ratio on AMD is 227. So that's about 10 times what the normal healthy price to earnings ratio is, which means that this company may be way overvalued and it was just moving purely on the hype around artificial intelligence. So we are leaning more bearish than bullish on AMD. Our next support in place is going to be 149. A break below that level can send the stock quickly back to 133, and below that level it's 119. Remember, these are pretty aggressive price targets, so make sure you guys are checking back in so we can update you guys on the weeks to follow. The next stock on our watch list is going to be Meta, which also broke below its key moving averages last week. Meta suffered a big fall to end the week. However, we are still leaning more bullish than bearish on Meta, but it may take some months for the stock to regain confidence. Remember, the stock was trading near an all-time high for quite some time, and it's not so easy to break out of an all-time high, especially when there is uncertainty in the market. Obviously, uncertainty is high from geopolitical standpoint, from our national politics, and of course, earnings. So with that being said, here are some levels to focus on for Meta in terms of resistance and support. We are expecting the stock to claw its way back up, but for now, we are expecting more chop. This is not really one we would play to the downside or the upside. We are holding a long-term position on Meta, and we're just awaiting for it to come back around. The last and final stock on our watch list is going to be Amazon, which closed below its 100-day moving average last week to end the week. This is a level that it has not broken below since it moved back above it in October or November of last year. So with that being said, this should be your focus point to start and end every day. Ask yourself, where did the daily candle close and open in relation to the moving averages closer to it? So Amazon, here are some levels to focus on in the short term. If you are bearish on Amazon, or if you're looking for more lows, Amazon needs to break below 178.70 to see further lows towards 173.80. And below that level, our downside price target is around 166 to 167. And in terms of resistance points, there are two resistance points in focus to start off the week. However, it needs to break back above 191.70 to regain bullish trust. So that's all we have for you guys this week. Hope you guys enjoyed this video, and best of luck.